Today, I'm going to talk about something that could change your family's financial future. It could save your children hundreds of thousands of dollars. Or it could cost them everything if you don't get it right. What I'm going to explain has to do with passing on your home or other significant assets to your children without creating a giant tax bill for them. This is simple but powerful stuff. This is something most people never learn until it is too late. And once you understand it, you will see why a simple trust can protect your family in a way that most people never even consider. Who needs to hear this? If you own a home, rental property, investments, or any asset that has grown in value over time, listen closely. Most people think that estate planning is something only wealthy families worry about. That is not true. Estate planning, and the way assets are transferred, affects almost everyone who has worked hard and accumulated something of value. You might think that by simply leaving your assets to your children in your will, or even by adding their names to a deed while you are alive, your job is done. But that is where most people make their biggest mistakes. The big myth: just give the house to your kids. A common belief is that if you want your children to inherit a home, you should add their names to the deed now while you are alive. People think that way it avoids probate. It is easy, and when I die, the house automatically belongs to my kids. On the surface, it sounds reasonable. It sounds like helping your kids now. But what most people do not understand is that this strategy can trigger one of the most destructive tax consequences in estate planning. And you might not even know it until it is too late. Breaking down: the tax problem, basis and capital gains. To understand why this is such a big deal, you need to know a couple of key tax concepts in simple terms. Every asset, like a home, has something called a cost basis. That basis is essentially what you originally paid for the property, plus any substantial improvements you made over the years. It does not matter how much that property is worth today. The basis remains tied to what was originally paid and what was spent on improvements. Let me give you an example. Suppose decades ago you bought your house for $100,000. Over the years, you spent another $90,000 on improvements, adding a new kitchen, a bathroom, replacing the roof, and so on. That brings your total cost basis to around $190,000. Now imagine today that same house is worth $750,000 or more. That means you have built significant wealth in that property. That is good news. But here is where most people get it wrong. If you add your kids' names to the deed while you are alive, the transfer is considered a gift for tax purposes. When a gift is made, the recipient inherits your old cost basis. In this case, $190,000. That old basis becomes their starting point for tax calculations. Let's say your kids decide to sell the house for $750,000 after you pass away. Because they have the old basis of $190,000, the difference between $750,000 and $190,000 is what the tax code considers a capital gain. That is a gain of $560,000. Capital gains tax is based on the difference between the sale price and the basis, and depending on income levels and tax rates, this can easily result in a tax bill of many tens of thousands of dollars, often approaching $100,000 or more, or even up to $200,000 when state taxes are added. That means a house you worked your entire life to pay for, maintain, and improve could end up costing your family hundreds of thousands of dollars in capital gains taxes simply because of how the transfer was structured. The hidden dangers beyond taxes. The tax issue alone is enough to make most people rethink adding kids to a deed while alive. But there are other serious risks too. Once you add a child's name to your deed, that house becomes part of their financial world. If that child later faces a lawsuit, creditor claim, divorce, bankruptcy, or any type of legal challenge, the home could be considered part of their assets. A creditor, an ex-spouse, or a court could potentially lay claim to that home. Also, once you give someone a co-ownership interest, you cannot take it back without their agreement. If relationships change over time, you could find yourself in a position where you cannot sell the property or make decisions about it without their cooperation. These are real risks that play out in real families every day. People thought they were being helpful and ended up creating conflict, legal exposure, and loss of control over their most valuable asset. The step up in basis secret now. Here is where smart estate planning changes the game. The United States tax code provides a provision known as a step up in basis. When an asset is inherited from someone who has died, the cost basis of that asset is reset to its fair market value at the date of the original owner's death. That means the beneficiary starts with the current value as their cost basis. Going back to our example, if your house is worth $750,000 when you die, that becomes the new basis for your children. If they sell right after inheriting it for $750,000, they would not have a taxable gain at all. Zero capital gains tax. That benefit is legally built into the tax law to reduce or eliminate huge tax burdens that would otherwise fall on heirs. Even if they sell later at a slightly higher price, the gain they pay tax on would only be the difference between that later sale price and the value at your death, not the decades-long appreciation that occurred during your lifetime. This tax benefit can save hundreds of thousands of dollars, especially for those who bought property long ago and have seen dramatic increases in value. Probate versus trust. How to get both benefits. So, if a step up in basis is so powerful, why not just rely on a simple will? Most people worry about probate, the legal process through which a will is validated by the court and assets are distributed. Probate can be slow, public, and sometimes costly. People think avoiding probate must mean adding names to deeds while alive. But that is a mistake. There is a strategy that avoids probate and retains the stepped-up basis. A revocable living trust. A revocable living trust is a legal arrangement where you place your property into a trust while you are alive. You remain fully in control of the property. You can sell it, refinance it, rent it, do whatever you want during your lifetime. But when you die, the property does not go through probate. It passes directly to your named beneficiaries according to the terms you set in the trust. Here is the key. For tax purposes, assets in a revocable trust are still considered part of your taxable estate at the time of death. Because of that, your heirs still get the stepped-up basis as if you had owned the property outright when you died. This means you can avoid probate and secure the huge tax benefit of resetting the tax basis to current market value, preserving more of your wealth for your family. Frequently made alternative mistakes. There is another variation of the add them to the deed idea that people sometimes adopt. They might add just one child as a joint owner with rights of survivorship, believing that this child will automatically inherit the property and then share with siblings. This has the same fundamental tax problem we discussed earlier. The basis does not reset, and capital gains taxes are still likely to be enormous. On top of that, this approach often creates family conflict because one child ends up with legal ownership while the others may feel left out, leading to arguments and resentment down the line. This is exactly the kind of situation that careful estate planning aims to prevent. You have worked hard your entire life to build your home, your property, your investments, and your legacy. Do not let a simple misunderstanding of the tax rules cost your family hundreds of thousands of dollars they could have kept. Estate planning is not just about who gets what. It is about protecting your family from unnecessary legal and tax burdens. A properly drafted trust gives you control, privacy, and peace of mind. It avoids the slow and often costly probate process. Most importantly, it can preserve the stepped-up basis that allows your heirs to inherit without a massive capital gains tax bill. Take action today. Educate yourself. Find the right professional help. Protect your legacy. Your family's future is worth far more than what a rushed decision or outdated advice might cost them. With the right planning, you can ensure that the wealth you leave behind benefits your loved ones, not the tax authorities. Start the conversation now, make the plan, and protect what you have worked a lifetime to build.